We are in a credit bubble. It so happens it's the largest credit bubble in history. It's truly global, far larger than anything between 1927 and 1929, which led to the Depression. And another reason that it's, I think, desperately important to point out that there is a difference between money, which I call a medium of exchange with no counterparty risk, and credit, which always has a counterparty involved. With this credit bubble literally teetering on the edge, and the thing that will push it over is higher interest rates, you can see that it's time for a wake-up call. And those who don't understand the difference between money and credit don't even understand money, really. But principally, the answer is to get out of credit and get into real money, which is gold.
Welcome back to the Gold Exchange Podcast. My name is Ben Nadelstein. I am joined by the one and only Alasdair Macleod, author of the Macleod Finance Substack, who joins us today to talk about money, credit, gold, and what he sees as the biggest factors that could shake the macro world in 2025. Alasdair, welcome to the show.
Thank you for having me, Ben.
Let's jump right in. So why is it critical, as you argue on your Substack, for people to understand the distinction between money and credit? And what are the people who don't understand that distinction missing?
Well, the two things I would say. Firstly, people have always had a very poor understanding of money and credit. And when they talk about money, they make no distinction between the two. So it is very, very important, and particularly at the moment, because what has happened is that we are in a credit bubble. And it so happens it's the largest credit bubble in history. It's truly global. Far larger than anything between 1927 and 1929, which led to the Depression when that unraveled. This is so big because successive credit bubbles since 1985-ish, when we had Big Bang in London and everything became a lot more financialized in terms of banking. There have been about 6 or 7 of these sort of bubbles building up, and they've always been, if you like, kicked into the next one rather than allowed to wash out the malinvestments and the banks and the businesses which really should go bust. I mean, when a bubble ends, you get a cleansing operation, and that just hasn't happened. So the result is that it's all rolled up into this mega, mega, mega bubble. And another reason that it's, I think, desperately important to point out that there is a difference between money, which I call a medium of exchange with no counterparty risk, and credit, which always has a counterparty involved. If you own a bank deposit, it's because the bank has a liability to you. You don't actually own it. It's just credit from the bank. Because of all the propaganda, particularly when Bretton Woods ended, the propaganda, particularly from the US government, has been gold is a pet rock. It's no longer central to the international monetary system. The dollar is the new gold, as it were, which is not the case. So with this credit bubble literally teetering on the edge, and the thing that will push it over is higher interest rates, you can see that it's time for a wake-up call. And those who don't understand the difference between money and credit, don't even understand money, really, it's very important that they do to protect themselves.
So let's talk about those higher interest rates, which you think could potentially be the pin to pop that bubble. So interest rates in the US have spiked over 5%. A lot of people were warning that this would cause a problem for equities, and yet stock market, equity markets seem to be doing all right at the moment. So first of all, how big do you think the pin needs to be to pop this bubble if this is kind of a larger bubble than we've seen before? And do you think only interest rates are the thing that can do it, or is there something else that can kind of pop this bubble?
Well, I'll answer the first question first. I have observed over the years that at the end of a bull market cycle in equities, you get both bond yields and equities rising at the same time. You then sometimes get a pause in the rise in bond yields, which allows equities to go even further, more extreme. And then when yields start rising again, it's at that point that the equity bubble gets popped. I mean, I've noticed this so many times over what, the 60 odd years I've been involved with the securities industry, if you like. So I think that's the first thing to understand. The second thing to understand is that credit is very much like anything else. If you restrict the supply of credit, then the cost of credit, in other words, interest rates, will rise. And we're seeing this manifest itself in various ways. I mean, firstly, the banks are no longer keen to lend on, to local businesses. So the sort of 80% of an economy, which is local businesses, if you like, rather than the big corporations, has been starved of capital and the liquidity, if you like, in order to carry stock and all the rest of it. Typically the sort of the problems, if you like, of a local retailer. And with some of the smaller and medium-sized enterprises on a local basis, which have an overdraft facility with the banks are turning around and saying, well, we want to cut this down. I mean, we would like to see your account run back to balance. But until that time, I'm afraid we're going to have to raise the rate at which we lend to you. And we're only going to lend you half as much. So you're getting these restrictions, if you like. The heart of this is that banks have now moved from a period of being greedy for business to being cautious about risk. And when they're cautious about risk and they assess that risk is more important, if you like, than opportunities in terms of lending, then, you find that the interest rates that they charge will start rising. And that has actually been the case for a little while now. The other thing you see is that they will move their balance sheets. I mean, because collectively they can't actually get rid of any credit. I mean, once it's in existence until someone goes bust and defaults. That's the only way it really goes. So what they will tend to do is to switch their lending from local businesses, small and medium-sized enterprises, etc., to governments who are, according to the regulators, less risky than lending to commercial enterprises. So everything is actually working against the productive side of the economy in that sense. And the other thing they do is they try and reduce the duration of their assets. They would rather be rolling over things on a more sort of cash-like basis than, let's say, lending stuff 5 years out. So this is the other problem, and it's raised a problem for governments because they've had to raise their debt principally out of treasury bill type instruments rather than longer maturities, which would give, if you like, a sort of a nice stable profile to their overall debt. So this is I mean, it's really quite simple. A lot of people think that the Fed or their central bank manages interest rates. Well, they can do something at the front end if we ignore the consequences. But when it comes to the longer end, they can't actually touch it. I know that lots of people talk about yield curve control and all this sort of stuff, but actually, in this situation, the banks are risk averse. Their balance sheets are over leveraged compared with where they would be, if you like, at the beginning of the lending cycle. I mean, at the beginning of the lending cycle, they would be something like 8 to 10 times assets to shareholders' equity leveraged. At the moment in the US, you're looking at about 14 times. So you can see that this is a situation which makes a banker really quite uncomfortable. That is why interest rates and bond yields are rising and will continue to rise. And there's a worse problem than that because of the G7 countries, all of them, with the exception of Germany and Canada, have government debt to GDPs in excess of 100%. This is extremely difficult. what it means is, particularly with the slowing of GDP and maybe even contracting GDP, that debt to GDP number starts soaring. And foreigners who basically price the debt, government debt on international markets, don't want to buy it. I mean, because they can see that this is, the debt is rising faster, if you like, than GDP. And on that basis, the nation is in a debt trap. So this is one of the reasons why China isn't buying, and it's also a reason why the Japanese institutions aren't buying. And I suspect that this reluctance to buy US Treasury debt will actually spread to other nations as well. So with the absence of buyers in the long-term bond market, because there you've got, do you want to own dollars is the first question. The second question is, do you want to own something with such a long duration for a yield of, say, 4.8% or whatever it is that the 10-year is at the moment? The answer is probably no. And so we're going to see bond yields, particularly out along the yield curve, rising, and it's not going to stop here. I think, getting back to the core of your question about the consequences on equities, I think once you see the US 10-year yielding more than 5%, I would be very surprised if the equity market can stomach that. I really would. And the point about this being the biggest credit bubble ever is that when it starts contracting, it's going to be unstoppable. And the consequences for all financial investments, which are all credit in themselves, I think is likely to be catastrophic to personal wealth. So that's why this matters. The relationship between interest rates and how they pop the bubble. I mean, first it's equities. Bonds are already, they're already suffering. Commercial real estate is already suffering. I mean, you've got another thing in the mix there, with people staying at home rather than using offices and so on. Residential property is also going to be badly hit, simply because mortgage rates are going to rise. So you can see that this is not a very happy scene. When a credit bubble goes pop, everybody gets really very badly affected. And the irony is that very few people actually know that we're in a credit bubble. It's the sort of thing they discover after the event.
So, can we talk about some assets that you would consider not a part of the credit bubble versus assets that you would say this is purely based on credit? So, one example on the credit side might be a zombie corporation. This is a company that they don't even make enough profit to service the debt revenue expenses. So the debt comes with interest expenses. Their revenues do not even cover those interest expenses. For 10 years, that would be qualified as a zombie company. Clearly, this is fueled by an excess of credit or lower credit and lending status. Versus something like, I'm going to let you fill in the blanks.
Okay, well, zombie corporations, basically, I suppose you define them as corporations which are not profitable and cannot service the debt. Now, as interest rates rise, then the number of zombies are going to increase. I mean, that is for sure, and they will start going bust. So, I mean, that one is quite obvious. And of course, an awful lot of government action, US Treasury plus Fed, in America's case, has been to try and stop those bankruptcies happening. But there will come a point where they can't really do it anymore. What they will probably do is they'll try and muscle interest rates down, even though at the long end yields will be rising. But then they're going to have a problem because that just undermines the value of the dollar and frightens off foreign investors even more. So, the situation actually becomes quite catastrophic. I think the point is that this is actually no longer under the control of the Fed or the US Treasury. So zombies, yes, quite simple. But the point about credit is that everything depends on credit. I mean, when you buy an equity, you think that you are protecting yourself against inflation, for example. This is a common story because a bit of inflation actually is probably good for the company's profits. So you would adjust your portfolio from say 60% bonds, 40 equity to 60 equity, 40 whatever, all that sort of rubbish, if you like, which the regulators encourage fund managers to work on. The fact of the matter is that when you own an equity, you actually don't own it. It's credit. What you're doing is you're buying the promise from the management of the company or the corporation to deliver to you with your interest an income stream, or profits in lieu, which may be retained in the company. But it's worse than that now because you don't even have that. The major shareholders of these companies are corporations like the DTC, I can't remember, DTC, DTCC, the depository trusts. You've got Euroclear in Europe. They actually own the shares and they issue you, if you like, you're on a register with them as having the interest, which is meant to pass through. This is certificateless trading, if you like, which sounds lovely. It's great. We don't have to worry about certificates and transfers and all the rest of it. Fantastic. But the problem is that when things go wrong, the relationship isn't between you and the company. You think you're a shareholder. No. This corporation, which is a middleman between you and the company, that's the shareholder. And it allows them to deploy their total ownership in the company as collateral. It still owes you your interest, yes, but you got no say in this at all. So you've got no protection at all as an equity shareholder. And that bit of distancing also happens in bonds, incidentally. Look at property. Now, this is the other thing. People say property is the best, physical property as opposed to financial property. Well, yes, but in terms of value, you've got a problem in that the purchase of property always depends on credit, and credit in two forms. Firstly, so-called money, which is actually bank deposit. It's a bank obligation to its deposit holders. And secondly, the pricing of residential property depends on the availability of mortgage finance. And when you get, a credit crisis such as the one which I now foresee, that finance isn't going to be available. So we're sort of rapidly whittling down. There is actually, the only things which you can own without credit are things like food, perhaps agricultural land unencumbered, because that will actually produce non-financial things for you. But principally, the answer is to get out of credit and get into real money, which is gold. And if you own gold, then okay, gold isn't going to own you anything because the whole idea is you hoard it against this calamity. And don't forget, incidentally, when it's all over, to sell your gold for whatever it is that becomes credit, because you then get back into the game, if you like, of using credit, but not before the credit actually collapses. So this is why you've got to understand the difference between money without counterparty risk, which is gold, used to be silver, used to be copper as well, and credit. Credit is not the place to be at the moment, and that covers virtually everything in the financial sector, as principals and also as agents.
I really like the way you discuss this distinction. And one way that I usually try to help people understand this is if you look at something like a bar tab, you go to your local bar, you say, hey, listen, I can't cover that today, but put it on my tab, right? So there's $5 that you owe those, that bartender or that establishment. That's credit, right? Versus when you go and you settle up, hey, I owe you, here's your $5, you've settled up with them. The issue is that credit, the thing that we're using as, hey, I owe you, is now also being conflated with the money. So there's an
Yep.
issue where the thing that gives you value, the thing that you say is money, has now been kind of swapped or merged into one thing, which is credit, with central banks saying, hey, don't worry, the value of the currency is now up to us. Versus
Yeah.
in the past with copper, silver, or gold, the
Yeah.
value of the currency or the money was the thing. It was that stable thing with no counterparty risk. So
Yeah.
can you quickly go over the global nature of this, right? So it used to be that certain central banks had tied their currency to gold. And so you could say at the end of this credit, there is, a kernel of gold at the bottom. But now we're in a global kind of economy, a global world with global irredeemable currencies. So have we ever seen a credit bubble that was global in nature, or is this the first in history?
I think this is the first in history, and you were talking just now about settling the bar tab, and the one thing which must be understood is that currency itself is credit, because I mean, and the way you find whether something's credit or not is there an obligation on the other side of it? And the answer is look at the Fed's balance sheet, and the answer is yes. The liability, the currency is a liability. And bank reserves on the Fed's balance sheet are a liability into the banking system, which in turn will probably have a liability to you if you're a depositor. So, don't forget that currency is also credit. By getting out of equities or getting out of bonds or whatever and thinking that, I've now actually got real money. No, you haven't. I mean, that's all a myth. So I think that's desperately important. Sorry, I've rather lost the thread. What was your question again, Ben?
Well,
I
that's
just
great.
wanted to make that point. I do apologize.
No, that is a great point, and I like the way that you put that, which is look at this thing you're holding, this asset, whatever it may be. Is there some other counterparty on the other side of this? For
Yep.
example, you can own real estate, but on the other side, there's someone who's holding the mortgage, right? You can have a share, but on the other side,
Yeah.
there's, an exchange or something like that. And
Yeah.
so when you hold something with no counterparty, whether that's gold or silver or some other asset with no counterparty, that's when you can start having the discussion, is this asset money? But when you look at
Exactly.
today's currency, pull out a dollar bill. You'll see Federal Reserve note. I'll let viewers look up what the word note means, right?
Yeah. I've
So
got
let
I've got something actually which will amuse you a little bit. The Bank of England notes always have, I promise to pay the bearer on demand the sum of, let's say, £1. Well, I mean, we don't have pound notes anyway, £10. Now that was payable in gold. Of course, that hasn't happened since 1932. It's a promise which is on the paper, but actually isn't discharged. Now, I mean, the thing that's fascinating is that on each time they redesign, a £10 note, the writing gets smaller and smaller and smaller, and it's getting to the point where it's not just my advanced age. I need not only glasses, I need a magnifying glass in order to read it. So that's the point. The other point about this is that this promise to pay the bearer, a £1 note, not that it exists anymore, but it's let's say it does. That was exchangeable for one sovereign. The sovereign today, and I was looking at the price earlier, they're £531 to one sovereign. So that gives you an idea as to what has happened to the purchasing power of the paper pound compared with the guarantee which the Bank of England is no longer prepared to honour, even though it is printed in small print on its notes. Sorry, I interrupted you again.
it's a great analogy. One I often use too is, imagine you go to a fancy restaurant, there's a coat check, they say, hey, pass us your coat, we'll put that away, we'll store it for
Yeah.
you, and here's a little claim to the coat check. And you walk
Yeah.
around, you have a fancy dinner, and it's time to leave, and they say, hey, listen, unfortunately we're no longer redeeming these little pieces of paper, these claims to coats. But the good news is, I understand it's cold out, it is raining, and you clearly want a coat, but the good news is that little claim, that little ticket, that little chit that you have is actually a coat. Most people would go, okay, that this clearly these people are crazy. They're defrauding me. They've stolen my coat.
I
But when it comes
like
to
it. Yeah.
money, we used to say, hey, here's this little piece of paper that, it can be redeemed, this pound
Sure.
for sovereigns. And now we can see that the amount of sovereign currency or gold compared to
Yeah.
these paper pounds has gone way, way, way out of whack.
Yeah.
So please
Yeah.
tell us about the global nature. So we talked about the pound,
Okay.
but
Global.
yeah, but other currencies are dealing with this as well, right? So
Yeah.
where do you see these other currencies? Is the yuan? Is it the ruble? Clearly, these aren't attached to gold in any way. So are these facing a worse fate than other currencies? And where do you rank the currencies in terms of strength?
Yeah. Basically, all paper currencies, all currencies, instead of being tied to gold, now refer, and they're not tied to the dollar, but they refer to the dollar. So, as Steve Hankey puts it, the dollar is the least dirty shirt in the laundry, which I think is a pretty good analogy. Now, what that means is that the dollar may indeed be weakening, losing purchasing power. I mean, obviously, it is, and I would say at a faster rate than indicated by the consumer price index. Uh, but other currencies are losing, purchasing power even more rapidly. And I think there is which I have to take issue with monetarists, because monetarists just sort of think there's a mechanical relationship between the quantity of money and its purchasing power. The problem with the fiat currency is that its value ultimately depends on the faith that its holders and users have in it. If they lose faith, it's valueless. And indeed, I mean, I think this is sort of admitted in a backhanded way by the U.S. government. It's you're buying the faith and credit of the U.S. government. When you hold dollars. Yeah, exactly. That's absolutely true. And this is independent of the quantity. Okay, the quantity has an effect. I mean, we know that it dilutes. If you issue more dollars, then you're going to dilute its purchasing power. Of course you are. But the overriding thing is the faith that people have in that currency. And it's that which is likely to disappear. Why? Because you're in a debt trap, one. And two, rising interest rates created by the debt trap, in effect, is going to prick the credit bubble. And then nobody wants the credit, any credit. I mean, you don't want lesser forms of credit like bonds or equities or any bit of paper, derivatives. Oh, that's another one. I mean, think of the value of derivatives is just absolutely astounding. So all this is going to suffer, if you like, a huge, great reappraisal of value. And as far as other currencies are concerned, I mean, they are down the pecking order, and I think that's the way to look at it. I would say the other thing, which we haven't mentioned yet, is if you look at the balance sheets of the central banks, they are all deeply in negative equity. I know there's been some publicity about the Fed, with as a result of doing QE. I mean, you could define QE as the means by which a central bank pays the highest possible prices ever for government debt, and that's actually what they were doing. And I mean, just look at the Bank of Japan's balance sheet. It's something like 40,000, 50,000 times underwater. It is. I mean, everybody thinks it really doesn't matter. But you get a banking crisis, and then you start trying to rescue the commercial banking network by not allowing anyone to go under. Then it's going to matter exactly, if you like, the sort of the hidden inflation within the system, because they'll be inflating from already a position of huge, huge, great balance sheet mess. And there is one area where this really does matter, and that is in the Eurozone, because the ECB doesn't have one shareholder. It has all the national central banks to turn to in order to recapitalize its balance sheet. Now, if it attempts to do this, it will find at the same time that the national central banks are in the same problem, and they're going to have to recapitalize their balance sheets. And if you imagine, say, the Bundesbank, which, as far as many Germans are still concerned, um, you know, has got to be, sort of sensible in its operations and non-inflationary and all the rest of it. I mean, can you imagine the debate when they have to ask for political permission? They've got to go to the politicians to pass legislation in order to recapitalize the bank and for the bank to recapitalize its share of the ECB. I mean, I can just see, and I've said this on other people's shows, if I was, a dumb politician in Berlin, I would turn around and say, well, look, hold on a minute. You want a couple of trillion euros in order to recapitalize both your bit and also the ECB. But hold on a minute, aren't you owed $1 trillion through the Target 2 system? Why can't you use that? You can see the whole thing beginning to fall apart at that point. Because, okay, there is a balance sheet liability owed to the Bundesbank of roughly €1 trillion. But they don't have access to it. This is all just myth. So the one thing I would see is that the euro is dead. I mean, even if by some miracle governments and treasuries turn around and say, look, we've got to try and stabilize this, and it does mean that we've got to go back to a gold standard, Bretton Woods 2, whatever. I mean, they're bound to do it badly, but anyway, let's just go over that one. At that stage, I think the euro's had it. I think it's out of the window. Because apart from anything else, I mean, I can see the Bundesbank and I can see the Bank of France, who are two big holders, and also the Italians, big holders of gold, turning around to the ECB and say, no, we're hanging on to our gold. You're not having it. So, yeah, I mean, this is going to be a disaster, I think, for the euro. So that's another answer to your basic question. I mean, the euro will be sinking like a stone, even against a falling dollar.
Let's talk about countries that aren't in the Eurozone and are not the United States. One could be Japan, for example. Japan has a crazy high debt to GDP ratio, and yet the Japanese economy, no one I think would potentially trade their economy for the Japanese. Maybe they would. But the biggest buyer of bonds is the Japanese government, is that Japanese central bank themselves, right? It's kind of an internal circle. So is there a certain number, you think, in terms of this debt to GDP ratio that the US or the Eurozone needs to hit before that same perpetual cycle happens where, individual investors, individual institutions don't want the debt, so the government has to buy it? Or is that more context dependent? Is there a certain number that investors should be looking for before they start saying, okay, a debt to GDP ratio of 125% is ridiculous, but 105, maybe a couple more bonds? Do you think there's a specific number, or is it context dependent?
No, I think context is the answer. I mean, the thing is that it depends on the savings rate. The thing that has saved the yen, even though it has been depreciating very heavily against the dollar in recent times, has been the very high savings rate. The savings rate does one thing, which is very, very important. It defers consumption. And what this means is that you have got, a level of production which comes out by producers, which exceeds the consumer demand. The excess demand gets recycled through the banking system to the businesses, who can then invest in capital, invest capital into better production means and all the rest of it, so that the prices tend to stabilize or even come down, assuming relatively sound money, which is not the case in Japan. But it's because Mrs. Watanabe, is a saver. This is the thing that saves it. It's also true, even more so, in China. I mean, the Chinese government are just pretty much reducing interest rates towards zero at the moment. But I think the reason that they're doing that is that they can see that the level of household savings is tending to rise. And that's what they're trying to kill, because they bought the Kool-Aid from the Keynesian boys in the West to a degree anyway, and they think, well, we've got to stimulate the economy because it's in danger of contracting, which is all a load of rubbish. I mean, the idea that GDP tells you what the economy is going is complete myth. What is GDP? It is the sum total of credit transactions over a period of time which qualify to be included in GDP. I mean, it doesn't even include all the credit transactions, but you can see, it doesn't tell you what the quality of any of those transactions is. And that's the vital knowledge which you need in order to be able to assess an economy. And I would say that I'm getting off topic slightly, but I like to think of an economy in terms of its potential to progress. Forget about growth. Growth is a non sequitur. You're looking at progress. That's really what you want to see. And if you can think in those terms, then you can see that there is absolutely no way that a government can actually try and manage progress, because you've got, a government basically is an organization with no skin in the game whatsoever, with completely different priorities. The priorities are political, not commercial. And so, this is why, high government spending always goes wrong. I mean, I've just come back from the Caribbean, and I think last time I was there, I was in Grenada. And the two examples which I think are worth drawing to, your audience's attention. There was a bridge built from the mainland to an uninhabited island, and it's still uninhabited. It's been boarded off with, wire fences, so you can't go over it. I mean, this was a, serious concrete bridge and all the rest of it. What, 100 yards long? Cost a lot of money to build. It was obviously done by one of the supranational agencies, like, I don't know whether it was the World Bank or, one of those guys, who presumably had to allocate some capital spending into the Caribbean. So they built this bridge to nowhere. When I was there, I think it was 6, 7 years ago, on the West Coast, there's a town on a river, and the means of getting from the south side to the north side were actually quite limited. And guess what? The Chinese were building a bridge. Now there was a need for a bridge there. Why the hell didn't the whichever supranational agency it was with this money to allocate? I mean, these become political decisions. And, the idea that, a government can do infrastructure and all the rest of it, they actually don't know the most effective use that those funds can be put to. And very often the decision has absolutely nothing to do with the practicality of a community or a nation or whatever. So, this is one reason why all this credit, which is being not deployed commercially at all, that's gone out of the window, is going to go bust. I mean, that's the way it's going. I mean, it's just been doing this for decades now. As I say, it's since the mid-80s, when we had the Big Bang in London, which eventually forced the end of the Glass-Steagall Act in America. Why? Because all the banks wanted to lend money to for financial purposes, not for productive purposes. And meanwhile, every business decided, well, the place to make things was actually Southeast Asia, where you can get a factory up and running in 18 months or less. The workforce are intelligent. They don't, you can train them because you heavily automate the whole process. And you've got these Asian women with very nimble fingers, and they're willing to work 12, 14 hours a day. Compared with unionized businesses in Europe, and trying to get planning permission to put in a factory. I mean, you've got to think 15 years ahead, basically, to make a widget. I mean, this is the crazy situation in Europe, and I think it's gone that way in America as well. So you can see how, with the financialization of paper currencies, the whole thing has got into this enormous super bubble, which has been prevented from popping along the way, just rolling up and rolling up and rolling up into a tsunami, which is going to crash on our shores.
I
Sorry.
want to ask. I want to come on a positive note now. So owning gold,
Yeah.
regardless of whether this credit bubble has popped or it's deflated a little bit or expanded a little bit, owning golds, even since the 1970s when gold prices were allowed to float more freely, has been a good investment. So obviously we don't give any financial advice on the show. But looking backwards, backcasting, right, from 1971 till today, gold has risen about the same as the S&P 500 on average. And of course, it's provided you that credit-free or that counterparty risk-free stability, right? You don't have to worry about
Yeah.
that extra risk.
Yeah.
So I want to ask you now, if it were the case that this credit bubble and this credit expansion continues, right, where governments are pumping GDP and we're building bridges to nowhere, but that continues, right, for longer than we expect. Instead of 1 year, 2 years, 5 years, 10 years, it goes on for another 20 years. Where do you see the role of gold? Do you think it will still be important as a hedge, just in case if that tsunami is to break, or do you see gold's role changing?
Yeah. Well, the first thing I would say is I hope that credit continues without bursting, because we're all going to get very badly hurt. Not just investors, but I mean, we're talking about governments going bankrupt and no longer being able to provide the welfare which everybody has become accustomed to, and the elderly, and all the rest of it. I think, to answer your question, Ben, I think it's important to understand, well, two things. Firstly, you own gold not as an investment. You own gold basically to get out of credit. It's a very, very important point. You're hoarding it. You're in cash, but this is real cash with no counterparty risk. I think that's the important thing. And when it comes to comparing it with something like the S&P, I mean, the S&P, the constituents of the S&P actually go out and deploy credit purposefully and productively and profitably. So, you're always going to get use out of credit. You don't get use out of gold. The second point I'd like to make is that the purchasing power of gold is non-volatile. I did a bit of research some time ago. I looked at Diocletian's edict of maximum prices. Now, we're going back to about 302 AD. So this is it's 1800 years ago, 1700 years ago. If I can get my maths right. And if you look at the prices of things in those Roman times, apart from the slave markets, which no longer exist, so we can't do that comparison. You look at things like, sort of foodstuffs, eggs, you look at beer, wine has gone down, actually. There's been some fluctuation, but generally the prices in gold are about the same. And this is interesting. And a colleague of mine, when I was at Gold Money, James Turk, produced a fascinating chart of oil, WTI oil, in both dollars and in gold. In fact, he did it in four major currencies. But the point is that in gold, the price just goes along like that. I think the most I've seen is it's risen, the price of oil rose in gold by about 2 times, 2.5 times. The worst was it lost 50% roughly of its value measured in gold. But look at it in dollars, for goodness sake. I mean, it went from, I think the 1950 price was something like $2.56 a barrel, up to $140 at one stage. And currently we're looking at 70. I mean, this is the difference. This is the point. You're not really buying gold. What you're doing is you're buying stability by getting out of credit. I think this is the important point. I mean, it's very, very important for anyone who thinks they're investing in gold. No, you're not investing in gold, because when you're investing in something, you look at the price, and we're all sort of accustomed to look at a price of a share or stock, and we've seen it rise, and we think, are we too late to get in? Perhaps we should wait until it comes back a bit. and doesn't quite come back, and it goes on a bit, and you reassess. And no, this is not the case, because it's not gold rising. It's your currency going down. So what you've got to think in terms of is my currency still going down for whatever reason, or has it stabilized? And that should determine whether you have all your eggs in that currency or whether you move into gold.
That is such a great point. I implore anyone listening, go back, listen. You are buying stability and getting out of credit. What a great point. Okay, I want to say something interesting for our viewers. If they haven't done it already, go to a site called pricedingold.com. Feel free to click around there. You can see the price of, for example, oil priced in gold, real estate, US, for example, priced in gold, as well as stocks. And you'll see some very interesting things. So for example, you can buy a house, on average, of course, no one buys the average house, but you can buy an average US priced home in gold for the exact same amount of ounces as you could in 1971. I won't spoil any other interesting tidbits that you can find on pricedingold.com, but I implore you to go give it a look. So, Alasdair, as we come towards the end of our interview here, I would like to do something called a lightning round. I will ask you a series of quick questions. Hopefully, I can make them quick. And you will answer as quickly or as short as you can. And then we'll move on to the next one. Are you ready?
Okay. Yep.
All right. So first, I'd like to talk about gold and silver. So the silver to gold ratio has been way out of whack. So first, can you explain to our audience what the gold to silver ratio actually even is and where you see it going in the future?
Yeah, it's the price of gold divided by the price of silver, expressed in the currency of your desire. You'll be interested to know that in Diocletian's time, the ratio was 12. So we're currently 88, I think, as this is being recorded. And I would see it go lower. Now, there is this sort of relationship that when gold really starts motoring, then silver motors almost twice as fast. The problem with silver is that when gold stops motoring, silver tends to lose value. But having said that, we're now in our fourth year of a supply deficit, according to the Silver Institute. And the liquidity, the above ground liquidity to make up the difference, which has been the case in the past, I think has drained out. I think as gold's value appears to rise, in other words, as I've just said, fiat currency is falling. When that process accelerates, I think you'll find that ETF demand for silver will build, and that is going to, if you like, squeeze the supply situation even more. So I can see that it could, for a period of time, act rather like gold on steroids. But all these things pause from time to time, and when the situation between gold and paper currencies pauses, silver will probably start losing value at that stage. So this isn't a slam dunk easy deal. But in general terms, because I do see paper currencies diminishing in their purchasing power at a faster rate over the next year or so, particularly as the credit bubble goes pop, then I think under those circumstances, silver will perform pretty well. It will outpace gold as a means of protection.
Alasdair, next question for you. So, perceptions of gold differ between Western and Eastern economies. So, what is one lesson that you think the West can learn from the East towards gold? And what's something that maybe the Eastern economies could learn from the West?
Right. Well, okay. The first way around, I think we should learn from the East that gold is money, because the People's Bank from China, for example, I mean, everybody's been commenting how, they've been buying gold. No, they're selling dollars. That's the key. So I think that's the first lesson. In terms of what lesson they can learn from the West, I think very shortly they'll learn the perils of being entirely based in credit, and they're going to have to protect their own currencies in this credit implosion. And I think that the reason they have been acquiring gold is that they know that they've got to anchor the value of yuan, rubles, whatever it is, to gold at some stage. But they don't want to act ahead of events because that would just destroy the dollar and create, I mean, it's financially the financial equivalent of a nuclear war, I think, which could indeed end up being a nuclear war. I mean, the consequences, I think, of anyone going onto a gold standard just undermine the credibility even more rapidly of our crazy credit system.
Okay, next question for you. So, Donald Trump, incoming US president, has recently proposed creating an external revenue service which would collect tariff fees. So, what are your views on tariffs, and should investors in the US expect more inflation in the coming 2025?
What I would suggest investors do is reread the history of the Smoot-Hawley Tariff Act and see the danger that tariffs can pose for the global economy and at the same time for the US economy. So these tariffs are not an easy solution. I know that tariffs have not been reduced for a very long time, and every succeeding president, I think, including from Reagan onwards, has somehow increased tariffs, either at a slow pace or a slightly faster rate. But I think Trump's reliance on tariffs is extremely dangerous. I really do. And it's going to undermine economic activity hugely, all the way around the world, including in America. And then, of course, the debt to GDP figure begins to look, I mean, we ain't seen nothing yet, sort of thing. So that's what I'd say about tariffs.
Next question, which is, are markets like China, for example, truly uninvestable, or is it just a matter of finding the right price?
I think it's a difficult question to answer. I don't think anything is uninvestable. The problem is, can you make money out of it or credit out of it, if you like? And that, I think, gets a bit more difficult. China, I think, would welcome foreign interest in its capital markets. Of course, it would. The problem has been that America has tried to dissuade people from investing in China. And that is really where the problem lies. So I think you'll find there's an awful lot of propaganda, if you like, from the American end, denying that China is investable. But equally, at the same time, if you like, geopolitical actions could actually threaten an investment in China. So, it's again, I take the view, just get the hell out of credit. don't invest in anyone else's credit. I mean, the American credit is probably better than anybody else's, despite, because of the currency relationship. That's the thing. So, yeah, I mean, basically, I'm a seller of all financial assets because they are credit. I don't want any credit.
Great answer. Next one. How do you see central bank digital currencies, sometimes called CBDCs, impacting the gold market, if at all?
I don't think it matters. I think this is a pipe dream. I mean, if you think about it, and I've read the papers from the Bank of International Settlements, they look at this as a means of a direct relationship between a central bank and businesses and individuals. They look at it as the basis of being able to promote certain types of business. Again, these are guys no skin in the game. They haven't, they don't know who to promote. I mean, how are you going to get progress? I mean, they get this idea, we must have AI. So we're going to funnel CBDCs into AIA, it ain't going to work. And from a practical point of view, I think for CBDCs to have a distinct existence as opposed to bank credit, commercial bank credit, it's going to require an awful lot of decision making, committees, back testing of systems and the whole thing. And not only that, but when I look at America, I'm told that every politician is funded by a bank somewhere down the line. And I'm not talking about just you know, we'll give you, we'll allow you to open an account and you can have an overdraft. No, this is money pushed into campaign funds by the banking system. And it was said a long time ago that, by an American businessman, his definition of a good politician is one who's bought and stays bought. So, are your banks going to, like turkeys vote for Christmas? Are they hellers like? I just don't see it getting off the ground. I mean, there's a lot of talk about it, and that's not going to go. But, there's nothing substantive coming out of this. There really isn't. I mean, the Bank of England did a white paper on it. Basically, they said, "Well, yeah, this is our idea of a CBDC. We'll just let the commercial banks handle it." Come on, that's not what the Bank of International Settlements was saying. So you can see that no, it's a damp squib.
Love it. Alasdair, final question for you. What's one question that I should be asking all future guests of the Gold Exchange podcast?
Do you understand the degree of the credit bubble? And if they say what credit bubble, you know to end the interview and just leave it there.
Alasdair, it was great talking with you. Where can people find more of you and more of your work?
Well, I've got my own Substack channel, and if you want to get an idea of the flavor, you can sign up for free. I've now got 10,500 followers. But I would urge you to consider being a paid subscriber because I'm in the process, or I'm in the business of trying to educate people about the dangers of faced by our economies, credit, geopolitics, and in the case of this country, which Britain, I mean, you'd be amazed at how quickly downhill the whole thing's going because our government is, well, let's put it this way. Oh, no, I don't know. I'll be too rude, I think, saying anything about our current politicians. They really haven't got a clue what they're doing. Imagine Kamala Harris becoming the next president. We have the same thing in Keir Starmer. Keir Starmer was Director of Public Prosecutions. That's his background. As I understand it, Kamala's background was as a Director of Public Prosecutions in California, I think. I don't know, I may have got that wrong. I mean, they know nothing about economics at all, and they're pushing an agenda which is actually destructive of economics. So that's why you should look at Macleod Finance, or it's alastair.macleod.substack.com. But if you just Google Macleod Finance, it should direct you in that direction.
Alasdair, it's been a great time with you. Your Substack is a fascinating read. I implore everyone to subscribe. For those interested in earning a yield on gold, paid in gold, check out monetary-metals.com. And Alasdair, thanks so much for the interview.
That's very much my pleasure, Ben. Thank you.